All right, as an analyst for Talk Tickers, today we are diving into one of the most famous numbers in all of personal finance, 4%. For decades, this has been the magic number, the go-to rule for a safe and secure retirement. But you have to ask, in the world we live in today, is the 4% rule still golden, or is it a dangerous myth? Let's get into it.
So here's how we're going to break it down. First, we'll look at the original promise of the rule. Then, we'll start to poke some holes in it, looking at big risks like market timing and, taxes. And finally, we'll explore some smarter, more flexible ideas to build a modern retirement playbook. Okay, first up, let's talk about why this rule got so popular in the first place. I mean, it basically offered a beautifully simple answer to what is an incredibly complicated question. How do you make your money last for the rest of your life? The appeal of this rule is just how simple it is. Imagine you've got $1 million nest egg. In year one, you take out $40,000. The next year, you just take that same amount and nudge it up a bit for inflation. What this does is create a predictable, steady income stream, and that is the absolute holy grail for most retirees. And this wasn't just some number pulled out of a hat. It actually came from some pretty serious academic research, most famously the Trinity Study back in the 90s. What these researchers did was look back at decades of U.S. market history to find a safe withdrawal rate, one that could survive the ups and downs of the market for at least 30 years. But that historical foundation, that is exactly where we start to see the cracks forming. So now let's really start to question the core assumptions that made this rule so famous to begin with. And that, right there, is the multi-trillion-dollar question for anyone planning for retirement today. The safety of this entire rule is built on a very specific slice of history from one specific country. So you have to wonder, how well does that really apply to the rest of the world or even to the future? Context here is everything. Research from retirement expert Wade Pfau really shines a light on this. The 20th century was, frankly, an amazing, maybe even unrepeatable period for the U.S. markets. When you compare it to 16 other developed countries, the U.S. had some of the best returns and the lowest volatility. So in a way, the rule was tested on the market equivalent of an all-star athlete having a career year. And this data just makes it crystal clear. In the U.S., historically, the rule failed only about 4% of the time. Not bad. But what happens if you apply it to France? Suddenly, it would have failed over 42% of the time. And Italy? Wow, a staggering 62.5% failure rate. This really suggests the 4% rule might be more of an American anomaly than some kind of universal law of finance. And even within that perfect U.S. data, the 4% rule wasn't exactly bulletproof. If you look at the maximum safe withdrawal rate for each year someone could have retired, you'll notice something interesting. For folks who retired in 1965 or 1966, the truly safe rate was actually below 4%, meaning if they'd stuck to the rule, they would have been at risk of running out of money. This brings us to probably one of the biggest and honestly most misunderstood dangers in retirement planning. It's called the sequence of returns risk. And the key takeaway is this. It's not just what your returns are, it's when they happen. Just picture this. Two retirees, they have the exact same average return over 30 years. The first one gets great returns right at the beginning. Their portfolio grows, it creates this nice big cushion, they're successful. But the second retiree, they run smack into a bear market in their first few years. They're forced to sell their assets when prices are low just to live, and their portfolio might never recover. It is an absolutely devastating trap. The data on this is just mind-blowing. Research shows that the market's performance in your first 10 years of retirement is responsible for a whopping 77% of your outcome. And the returns over the next 20 years, they only account for about 5%. That's right. The beginning of your retirement, that's the absolute danger zone. Okay, so on top of all that market risk, there's another huge factor the simple 4% rule just kind of brushes over. And that's taxes. The government wants its cut, and that cut can take a massive bite out of your planned retirement income. Just look at how dramatically taxes can change the game. If all your money is in a tax-free Roth account, great, you can spend that full 4%. But if it's in a regular taxable brokerage account, your real spending rate drops to about 3.68%. And what about a traditional tax-deferred IRA? Well, your safe after-tax spending rate plummets to just 3.23%. That's a huge difference. Let me put that in perspective for you. A $120,000 withdrawal from a $3 million tax-deferred account could mean that over $23,000 of that goes straight to taxes. That's almost 20% of your withdrawal that isn't paying for your trips or your grandkids' presents. It's going straight to the IRS. Forgetting about taxes is a really critical mistake. So, if the 4% rule is too rigid, too US-focused, and totally blind to taxes, then what's the alternative? Well, the answer really is about shifting our thinking from a static, fixed rule to a dynamic, flexible plan. This quote from researcher Wade Powell just nails it. Individuals should not expect constant spending from a volatile portfolio. It makes perfect sense, right? The market zigs and zags, it's unpredictable, so your plan has to be able to adapt. The goal is a strategy that can bend but not break. A really popular one of these dynamic methods is called the guardrail strategy. Instead of a single, rigid rule, it's more of a flexible playbook. You might even start a little higher, maybe around 5%. But here's the clever part. If the market soars, you give yourself a 10% raise. If the market tanks, you take a 10% pay cut. You see? It builds responsiveness right into your plan, which lets you enjoy the good years while protecting yourself from the bad ones. So, what does this all really mean for you and your planning? Let's try to boil this all down into a new, smarter retirement playbook. Here it is, your new playbook. First, think of the 4% rule as a starting point, a guideline, not an ironclad law. Second, you have to protect yourself during that super critical first decade. Third, make taxes a primary part of your math, not something you think about later. And finally, and maybe most importantly, build flexibility into your plan. You need to be able to adapt. At the end of the day, searching for one single, perfect, magic number for retirement, it's probably a fool's errand. The world is just too dynamic for a static rule to work forever. The real goal is to build a strategy that's robust, responsive, and can handle the inevitable twists and turns of a 30-year retirement journey. And just a final, important reminder, this analysis is for informational purposes only. This is not financial advice.